Okay, I wanted to introduce the financial analysis template. This is a Excel tool that I've created to help people do their preliminary financial analysis for a marketing plan or business plan. So if you're at the financial analysis first draft assignment, click on the link to open the Excel spreadsheet. I'm going to move this into the space. I'm going to go over this pretty quick. If you need to pause to review, you can do that. Don't forget to click on Enable Edit. And this is a spreadsheet that I've created to help people do preliminary financial analysis for a marketing plan or business plan. It's set up with 6 different categories of products. So if you have more than 6 categories of products, you're going to need to group them into at least 6 categories and use average cost and average selling price to get your analysis completed. If you have fewer than 6 categories of products, you can simply blank out the text in this column and simply place zeros in the green columns. So for example, if I didn't have any accessories in my product line, I could make this a 0 and make the selling price a 0 and then the quantity a 0 also, so that this particular line wouldn't have any effect in the analysis. So the only areas that need to be inputted with values are those areas outlined in green. The average cost per unit, the average selling price per unit, and the annual number of units or quantity of each product. The example set up to support or illustrate a clothing line that sells shirts, shoes, skirts, dresses, pants, and accessories, as you can see. So this first column is the average cost per unit. This would be the cost that it takes to actually manufacture the product if you assume a manufacturing business, or this is the cost that it would cost the company to buy or acquire the product. And then the average selling price is the price that the company sells the product to its customer. The annual quantity is your forecast of how many units of each type of product that you have that you expect to sell each year. This total quantity is totaled here at the bottom, and these areas in, I guess what you might call mauve or pink, are simply information fields to illustrate the calculations for each item of the product line. So it calculates the total revenue by multiplying the selling price by the quantity. It calculates the cost of goods by multiplying the quantity by the average cost per unit. And then these areas here repeat the cost and the selling price, which is not really necessary, but I do that for the sake of illustration. Likewise with the quantity. And what's being calculated here is the proportion that each type of product contributes to the overall weighted cost and the weighted selling price. So this is a weighted average calculation, if you're familiar with that. If not, you can actually click on these individual cells, and looking at the formula line, formula bar, you can see how each one of these numbers is calculated. But even if you don't understand Excel very well, you can still use this tool to get to information that can be helpful in your analysis. I'll talk about the break-even calculations in a moment. So this projection is divided into 3 years, year 1, year 2, and year 3. You may have to scroll down to reach the items in year 3. I'll enlarge this to make it a little bit easier to read. So the types of things you'll have to decide is, what are your costs? You should do that through research or through estimates. You may decide that your costs are going to increase from year 1 to year 2 and year 3. You may decide to change your prices from one year to the next, and likewise, If you're in a growing business, you would expect your quantities might change. And if, for example, we decided to change the number of shoes, we could simply type in a new value. Let's say we're going to go from 4,000 to 8,000 shoes in that second year. And let's say we're going to go from 4,000 to 5,000 skirts. And you can see as you change these quantities, the revenue and the cost of sales numbers will change, as will the weighted cost and the weighted selling price. So if you like, you can kind of play around with these numbers, do some what-if analysis. What if my quantities change? How will that impact my overall business? So these numbers in green are completely up to you. Down below then, the revenue, cost of goods, and the revenue and cost of goods numbers are transferred from up above. So if you look at these total numbers here, you'll find that these are the same numbers that are transferred in years 1, 2, and 3 in this pro forma income statement. The gross margin, or sometimes referred to as a gross profit, is simply the revenue minus the cost of goods. So that gives you the overall revenue picture for your projection. The operating expenses, as you see here, are basically estimates. And this is kind of a general laundry list of the types of expenses that businesses might have. If you don't need these expenses, you can simply, again, blank them out or simply enter zeros into this first green column that has dollar amounts, and that will convert years 2 and 3 to 0. This first column in the green is simply a growth percentage. This is the percent that you think each one of these items might grow from one year to the next. So the calculation is to simply take the first year's value and add whatever the growth percentage is for years 2 and 3. A 23% growth figure is probably far too high. And if you want to see no growth, you can simply make that growth percentage a 0 as well. So again, you'll have to think about your business, what type of expenses you're going to have, and adjust those accordingly. Do not use these numbers. These are here just as placeholders to illustrate. All of the operating expenses then are totaled, and the operating expense number is subtracted from the gross margin or gross profit from above. You can see that by double clicking this cell. And it shows you that the gross margin value and the total operating expense value are used in calculating the income before taxes. If you happen to double click on a cell like this to see the calculation, make sure you press the escape button so you don't mess up the calculation. This particular spreadsheet uses a 25% income tax rate. If you want to change that to 20% or whatever the current corporate tax rate is, or if you're using your personal income tax rate, for example, if you have an LLC, your income would be taxed at whatever your personal income tax rate is. You can change that value as well. After calculating the income tax, it then subtracts the income tax from the income before tax to give you the net income after tax. Now, make a note of the total operating expenses. 1,637,700, for example, and you'll see that this value is transferred up above into the area below the weighted average calculations. This is the operating expense, and the weighted average selling price, which comes from the weighted selling price calculation up above, along with the weighted average unit cost, which was calculated up above. These two values are used to compute the weighted average unit margin. And if you divide the weighted average unit margin into the total operating expense, that will give you the number of break-even units. Now this, of course, is an average break-even unit calculation because the selling price, the unit cost, and the margin are all based on a weighted average. So this is an approximation of the break-even number of units you would need to sell in order to cover your operating expenses. And that's the definition of break-even. If we take the selling price, subtract the unit cost to give us the margin per unit, and then we divide that margin per unit into the operating expense, or the total fixed cost, that tells us how many units we need to sell in order to break even. I've then taken this number and distributed it across the various product lines using these same weighted numbers. So you can see that we take the break-even units multiplied by the weighting for the number of shirts being sold out of our total quantity of product. And we're essentially saying we need to sell 953 shirts in order to break even. And this gives you an idea of what your product line sales needs to look like in order to break even. Now, of course, there are a lot of other combinations of units that you can get in order to break even, but this is a reasonable approximation. The same type of calculations are done for year 2 and year 3. So it's very important that you spend some time doing research on cost, think about your selling price and what type of selling strategy you're going to use, and lastly, a reasonable projection of the number of units that you think you can sell. Now, if you find out, for example, that your break-even quantity is really not reasonable, then you've got to go back and think about what can you do to alter some of the inputs in your marketing strategy in order to get to, at the very least, a reasonable break-even point. So this spreadsheet tool will give you the opportunity to do some reasonable financial analysis and think about what it's going to take to make your business not just viable, not just break even, but profitable. When you're finished and satisfied, you can actually click on File. The print parameters for this spreadsheet are already set up as well. If you click Print, you'll see that it prints out 3 pages. One page is the pro forma income statement, the projected income statement. The second page is the forecast for the 3 years. And the third page simply shows all of the weighted average calculations that are done. So, at the very least, if you wanted to, you could print this out in hard copy form, or if you have the ability to print a document as a PDF file, you could then move that PDF file into your Word document, or you could literally cut and paste portions of the spreadsheet into a Word document as well. So email me if you have any other questions about this spreadsheet, but this is a way of getting started. Of course, if you are proficient in Microsoft Excel, you can use your own spreadsheet, create your own, or you can use someone else's spreadsheet tool. There are numerous spreadsheet tools for financial projections out there on the web that you might want to use, but at least this will suffice for our assignments.